Welcome back to Lucia Capital Group Weekly. I'm your host, Ray Jr. We're getting close to income tax time, which means you're probably thinking about ways to keep your tax bill low or to increase your refund. That's great, but make sure whatever you put on your return can be substantiated in the event of an audit. Take what you're allowed, but don't get greedy and cross the line. So what can trigger further scrutiny by the IRS or even an audit? Any number of things, really. It's true that those with larger incomes are generally more likely to be looked at more closely by the IRS, but there are other so-called red flags that could shine the spotlight on you. Here are some red flags you might want to consider. First, taking large medical or charitable deductions. The IRS is pretty good at figuring out how much the average taxpayer normally gives to charity and or spends on medical expenses given their level of income. So if you're kind of an outlier, it might show up as a red flag. The home office deduction is another potential red flag. Make sure if you take this deduction, your home office is used exclusively and regularly as an office and nothing else. It also has to be the principal place where you do business. So if you have another office somewhere else, your home office might not necessarily count. Finally, the IRS may look at your deduction for the business use of your vehicle. If you claim this deduction, you should be prepared to show that you really do use it for business purposes. If you claim 100% deduction, be careful. It's highly likely that at least once in the year you use your primary vehicle for non-business purpose. That is, unless you drive a hearse or maybe a delivery truck. Well, that's it for this week. As always, if you want to contact me directly, you can do so at the button below. It's called the Ask Ray Jr. button. I'm here for you. Have a great week. See you next time.